In late March of 2026, the US Department of Labor proposed a rule that barely made a splash in the mainstream news. The stock market didn't move. The financial headlines gave it a few paragraphs. But for the 90 million Americans who rely on a 401k to fund their retirement, this might be the single biggest change to how they invest in decades. And most people have no idea it's happening. The Kiplinger tax letter for May 2026 called it one of the most significant developments in retirement policy this year. And yet, ask your coworkers what they think about alternative assets in their 401k, and you'll probably get blank stares. The rule is about something called alternative assets in 401k plans. Private equity, cryptocurrency, real estate funds, infrastructure projects, commodities. The kind of investments that have historically been reserved for hedge funds, university endowments, and the ultra-wealthy. Now, the government wants to make them available inside your workplace retirement plan. Here's the question nobody's answering clearly. Is this a good thing or a trap? Let's start with what actually happened. In August of 2025, President Trump signed Executive Order 14330, titled Democratizing Access to Alternative Assets for 401k Investors. The order directed the Department of Labor and the SEC to find ways to lower the barriers that had kept alternative investments out of defined contribution retirement plans. On March 30, 2026, the DOL followed through. They issued a notice of proposed rulemaking that would create what's called a safe harbor for plan fiduciaries. In plain English, it makes it much harder for 401k plan sponsors to get sued for including alternative investments in the lineup. Historically, that fear of litigation is exactly what kept these options off the menu. Now the government is basically saying, if you do your homework and follow these 6 criteria, you're protected. This is a huge shift in philosophy. For decades, the retirement industry operated under a principle of default conservatism. If a plan sponsor wasn't sure whether an investment was appropriate, the safest answer was no. That kept fees low, volatility manageable, and most participants in boring but effective index funds. The DOL's proposed rule flips that default. It says sponsors who consider alternatives in good faith and document their process should not fear legal consequences. That is a genuinely meaningful change in regulatory posture. The 6 criteria are worth knowing about: performance projections, fees, liquidity, valuation, performance benchmarks, complexity. A plan fiduciary is supposed to evaluate each of these factors before adding an alternative investment to the menu. On paper, that sounds responsible. In practice, it's worth asking whether most plan sponsors and participants genuinely understand what they're getting into. Because here's the uncomfortable truth about the 90 million Americans in 401k plans. Most of them have never heard of private equity. They don't know what a carried interest is. They think crypto is either a scam or a lottery ticket. And they absolutely do not have the tools to compare a private equity fund with a 0.03% expense ratio S&P 500 index fund, because those two things are not comparable in any meaningful way. The argument for alternatives is that they offer uncorrelated returns, that they provide diversification that a pure stock and bond portfolio doesn't, that institutional investors use them successfully. All of that is true. University endowments like Yale and Harvard have been investing in private equity for decades, and it's worked well for them. But here's the part you don't hear in the sales pitch. Yale manages $42 billion. They have a team of investment professionals who can fly to any city in the world, meet with any fund manager, and negotiate fee structures that individual investors cannot even dream of. You, with your $60,000 401k balance, are not Yale, and you will not be treated like Yale. Josh Brown, the CEO of Ritholtz Wealth Management, put it bluntly in a recent interview on CNBC. The average investor, by definition, does not need alternative assets in their portfolio. We have trillions of dollars in 401k balances, and in many cases individual investors have substantially outperformed professional investors, mostly because they kept costs low and kept it simple. He's right. The data is overwhelming. SPIVA, the S&P Indices versus Active Scorecard, has been tracking active versus passive performance for over 20 years. Year after year, about 85 to 90% of large-cap fund managers underperform the S&P 500 over a 5-year horizon. Over a 15-year horizon, that number climbs to nearly 95%. And these are professional money managers with teams of analysts, Bloomberg terminals, and direct access to company management. If they can't beat the market, what chance does a private equity fund of funds inside your 401k have? The argument for alternatives is that they're supposed to be uncorrelated, that they zig when the stock market zags. But private equity is actually highly correlated with public markets, just with a lag. When the stock market crashes, private companies eventually feel the pain. It just takes longer for the valuations to adjust. Meanwhile, you're locked in. You can't rebalance. You can't reduce your exposure. You just sit and watch as annual reports tell you your NAV is stable until the fund eventually marks down and the correction hits you all at once. This has a name in academic finance. It's called stale pricing. And it's one of the reasons private equity looks less volatile than public markets. It's not actually less volatile. The volatility is just hidden, and hidden volatility is dangerous because it creates the illusion of safety, which can make you take on more risk than you realize. And fees are the real story here. The typical S&P 500 index fund charges between 0 and 0.03% in annual expenses. The typical private equity fund charges 2% in management fees, plus 20% of any profits, what the industry calls 2 and 20. Over 30 years, that fee gap is catastrophic. If you invest $10,000 a year into an S&P 500 index fund, earning 7%, you end up with roughly $1.4 million after 3 decades. If you invest the same money into a private equity fund that earns 9% gross but charges 2 and 20, your net returns drop to around 4.5%. You end up with about $700,000. The same gross returns, but less than half the money in your pocket. That's what fees do to compounding. There's also a liquidity problem that almost nobody talks about. An S&P 500 ETF trades every second the market is open. You can sell it this instant, get your cash in 2 business days, and use it for whatever you need. Private equity does not work that way. When you commit capital to a private equity fund, your money is typically locked up for 7 to 10 years. You can't get it out early without paying a massive penalty or selling your position on a secondary market at a significant discount. For someone in their 20s or 30s, 10 years might not matter. For someone in their 50s or 60s who might need to access those funds for retirement income, a liquidity lockup is a serious risk. The cryptocurrency piece adds another layer. The Biden administration had previously warned 401k fiduciaries to exercise quote-unquote extreme care before adding crypto options. That guidance was rescinded. The current administration's approach is much more permissive. And look, I'm not here to tell you whether Bitcoin is going to 0 or a million. What I can tell you is that crypto is one of the most volatile asset classes in existence. A 60% drawdown is not unusual. Putting retirement money that you cannot afford to lose into an asset that can lose 60% of its value in a single quarter is not prudent investing. It's gambling. Now, to be fair, not all alternative investments are speculative gambles. Real estate investment trusts, infrastructure funds, commodities, and private credit can serve legitimate portfolio roles. Some of them provide income. Some provide inflation protection. Real estate has historically kept pace with inflation better than bonds. A dedicated REIT allocation inside a retirement portfolio is not unreasonable. But here's the thing. Most of these alternative options are worse in a 401k than they are in a taxable account. The tax advantages of a 401k already solve the problem that alternatives are typically best at addressing. Private equity generates a lot of short-term capital gains. Doesn't matter inside a retirement account. Real estate generates taxable rental income. Doesn't matter inside a retirement account. The tax shelter of the 401k already handles that. So you're paying extra fees for features you don't actually need. The EBRI's 2026 Retirement Confidence Survey found that only 64% of Americans are confident they'll have enough money to live comfortably in retirement. That's down 6 percentage points from the previous year. Worker confidence took an even bigger hit, falling to 61%. Meanwhile, retiree confidence dropped 5 points to 73%. At the same time, inflation is back above 3% for the first time in months. The Consumer Price Index rose 3.3% over the 12 months ending in March, with the Energy Index surging nearly 11% in a single month. Gas prices jumped 21% in March alone due to the disruption in global oil supply tied to the military action in the Middle East. Americans are stressed about money, and they are looking for answers. The danger is that alternative assets get sold as a solution to that anxiety. That people hear private equity or crypto and think these are secret strategies the wealthy have kept from them. That they abandon a perfectly good index fund strategy, chasing something that sounds more sophisticated. If your 401k plan adds alternative investment options, here's what I'd recommend. First, understand what's actually being offered. Is it a diversified private equity fund of funds or a single-sector real estate partnership? There's a world of difference. Second, look at the fees. If the expense ratio is more than 2 or 3 times what you're paying for your index fund, run the numbers on what that difference compounds to over your career. Third, consider your timeline. If you're more than 15 years from retirement, alternatives are less risky because time gives you liquidity. If you're within 5 years of retirement, avoid locked-up investments like the plague. But for most people, the right answer is still going to be a low-cost, diversified index fund portfolio inside their 401k. Max out your contributions, choose a broad market fund, set up automatic investments, and don't touch it. That strategy has worked for decades. It has survived bear markets, crashes, recessions, and every other crisis. It will survive this change too. The alternative asset rule is not a bad idea in principle. For sophisticated investors with high net worth, large portfolios, and long-time horizons, alternatives can add genuine value. But for the typical American with a mid-5-figure 401k balance, the simplest strategy is still the best strategy. The math of compounding works in your favor only when you don't let fees eat away at it. And alternatives, by their nature, are the highest fee products in the financial industry. The Department of Labor's proposal is still in comment period. It hasn't been finalized, but it signals a direction that's unlikely to reverse regardless of who's in office. The question for you is not whether alternatives should be in your 401k. The question is whether they should be in your 401k. And for most people, the answer is going to be no. Keep it simple, keep it cheap, keep contributing. And let the next 30 years of compounding do the heavy lifting. That's not financial advice. It's just the math. And as always, this is Wealth Unlocked, understanding how money works, one conversation at a time. See you in the next one.